The market's riding high, but can earnings keep the story alive? Investors are bracing for another volatile earnings season, and with stretched valuation, the pressure is on to deliver. Added uncertainty around President Trump's policies and growing whispers of an AI bubble, this quarter could be a turning point. So will companies live up to the hype, or will cracks finally start to show? Mikhail Zverev is a fund manager for Amati Global Investors. So Mikhail, S&P 500 earnings are expected to rise 8.8% in Q3 from a year ago, while a slowdown from a 13.8% jump we saw last quarter. Should investors brace for disappointment?
I don't think so. Last quarter was really tough because this was the brunt of the post-tariff hiatus and spending. Everybody paused their decisions. Companies didn't have confidence to invest. But as one company we spoke with recently said, our customers can only hold their breath for so long. So the purse strings are being opened. We're likely to see at least a rhetoric around improving pipelines of projects or order books, if not the actual improvement in sales. So we're optimistic that Q3 will actually look quite positive.
Meanwhile, AI continues to dominate, but concerns about a potential bubble are growing. With billions being poured into unproven tech, could this be the moment that the euphoria fades?
Not yet, but we share your skepticism. We're pragmatic optimists in AI. It's really useful technology, transformative in some cases, but we're still some way off proving the ROI on this enormous amount of capex that goes into AI data centers. And so I think these projects are set in stone. This money will be spent. The next 12 months will continue to see this very strong capex cycle, but sustainability of that is a cause for concern. And what we're looking for, we're not invested in the headline AI companies. We're looking for opportunities on the periphery, companies that provide photonics communications equipment into that space, which actually growing their share of wallet in AI capex, so they'll do well even if this hyper growth moderates, or companies that make memory semiconductors, because we're just accumulating so much more data. Even with the tools we have today, the models we have today, we can do more with data, and the data volume is growing, and memory is where that data is stored and crunched. So we think these are more, if you like, asymmetric ways to benefit from AI.
So within those more specialist corners of the markets, what names are jumping out to you?
So we like Lumentum and Fabrinet. They are not on everybody's front of mind, but that's kind of how we invest, innovation off the beaten track. They are the companies that make photonics interconnect, moving that data flow from electrons and copper wires to photons and optical fiber, and that's just technologically inevitable. And then in memory, more well-known companies, SK Hynix and Samsung Electronics, are the dominant suppliers of this high-performance memory into data centers, but also on devices. Our iPhones will run more AI on device and will need a lot more memory on device. So that's good for demand.
So with the government shutdown dragging on, we are in a macro vacuum. Should investors expect stock-specific moves to drive volatility in the near term?
That's what we focus on. We're bottom-up investors. We take a 3-year plus time horizon. So we don't really have a view on macro. We just had another bout of trade war uncertainty over the last couple of days. We find transitory macro concerns like this an opportunity to buy companies that sell off, sometimes overreact to the, in our opinion, transitory temporary bad news, and where the underlying fundamental longer-term structural growth opportunity is intact.
Let's turn to the defense sector now, and investor optimism over rising military budgets has shifted to frustration over delays in order books. What would help reassure investors?
This industry moves slowly, but in our opinion, both the increase of the spending is inevitable, but also more relevant to us as innovation investors, a shift towards more technological solutions within defense is inevitable. And we're looking for that compounding effect of, yes, more money being spent in the long run, but also money being spent on different things, drones and anti-drone defense, a lot more computing and sensors everywhere from the battlefield equipment all the way to the space sensors, but also cyber defense, cyber offense, intelligence, cyber technology for intelligence. They are wallet share growers within defense spending, and there are specific companies that benefit from that.
So finally, President Trump has imposed a 100% tariff on patented drugs not produced in the US. Could these demands, along with pressure to cut prices, weigh on the pharma sector?
Well, it has been weighing the pharma sector. It continues to do so. We've seen a settlement of sorts with Pfizer that looks like it'll be a blueprint for others. The concessions that they've made are manageable, very moderate. They give the president a win, but they do not destroy the economics of the business. But actually, the the offset to that is a real pressure to onshore manufacturing, to bring pharma manufacturing onshore, which in our opinion, again, is inevitable. It should be done. And there are some companies that supply, for example, bioprocessing equipment that makes those drugs that will benefit from what we think going to be a capex boom, an investment boom in pharmaceuticals industry over the next several years.
That was Mikhail Zverev at Amati Global Investors. Don't forget, you can watch more videos on Reuters.com.